Today is the 29th of August 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500, which fell fairly heavily towards the end of last week. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Let's start with this analysis that we've been tracking for many months now in the SPX. The important features of this analysis are, of course, the prominent trough in March of 2020, which you can see has been phased as a trough of the 9-year cycle. I think this is a trough of at least 54-month magnitude. Whether it is also a 9-year cycle trough is a subject for a separate video. Then we have the 18-month cycle over here at the beginning of October. That was a fairly difficult cycle trough to position in the analysis. And if you go back and take a look at the market update videos that I was doing at the time, you will see we were struggling to position that 18-month cycle trough. As you can see, I have influenced this analysis. That's what that pin symbol means over here at the foot of the chart. I have influenced this analysis. In other words, I have told Sentient Trader that I would like the 18-month cycle trough to be at that position. That means that the recent trough that we have encountered in the middle of June was a trough of 40-week magnitude. The underlying message to this analysis is not a particularly bullish one, because we had a very bullish 18-month cycle that elapsed over here up until the beginning of October. But then this 40-week cycle created an M shape that was, of course, very bearish. It brought price down lower. And the next 40-week cycle, bringing us down into the next 18-month cycle, expected, according to this analysis, near the beginning of next year, is expected to be less bullish, or in fact, of course, more bearish than the 40-week cycle that we have recently completed in the middle of June. And so that is why this is a fairly bearish analysis. We are expecting the cycles to turn bearish to bring us down into that 18-month cycle trough early next year. But let's zoom in and consider what has been happening since that 40-week cycle trough in the middle of June. Here it is, and you can see that the 40-day cycle trough has been moved in this analysis. In the previous market update about the S&P 500, it was at this position over here in the middle of July, because we did witness a very clean M shape to this cycle. And when we take a look at the alternate analysis that I have been discussing in recent videos, we will consider the position of this 40-day cycle. The reason that it has moved in this analysis is because price is now moving down fairly strongly, as can be seen. The past 2 weeks have been fairly bearish. Price is coming down into what is expected, according to this analysis, to be an 80-day cycle trough. The average length of an 80-day cycle, discovered by Hurst 50 years ago, is 68 days. And you can see that if this had been an average length cycle, then it would have formed its trough about a week ago, if that had been an average length 80-day cycle. The recent average of the 80-day cycle, according to this analysis, you can see at the bottom right-hand side of the chart, that is 65 days, give or take. And so this is certainly when we are expecting an 80-day cycle trough to form. The fact that price dropped down strongly on Friday indicates that that 80-day cycle trough has not yet formed, because it would be extremely unusual to have an 80-day cycle trough form and then only 2 days later the peak of the next 80-day cycle to form in the market. That would be an extremely bearish turn of events. So it is more likely that the 80-day cycle trough is still in the process of being formed. When we take a look at the alternate analysis, I will revisit the idea that the 80-day cycle trough might in fact have formed over here in the second week of August, as discussed in previous market update videos. So the 80-day cycle, of course, should form at about the level at which we find the the 80-day FLD. The reason for that is because in the FLD trading strategy, we track a fairly reliable sequence of interactions between price and the FLD. I mostly refer to the 20-day FLD because that's a very useful and very reliable cycle to discuss in these market update videos. But the same principles apply to all of the cycles, except for a few exceptions, because we require a 2-to-1 harmonic ratio between the cycle wavelengths. And so when the 18-month cycle, for instance, is included in the set of cycles that we are monitoring, then the sequence changes ever so slightly. But at the 80-day cycle level, we don't have to worry about that. We are expecting the same sequence of interactions between price and the FLD. So following an 80-day cycle trough, which is of at least 40-week magnitude, as was the trough in the middle of June, according to this analysis, our first interaction would be an A category interaction where we expect price to cross up above the FLD, reach up and achieve its target generated by measuring the distance from the trough to the crossing point at which the price crosses the FLD, of course, and that target was up here. It was achieved in the last week of July. If this was a 40-week cycle trough, we would expect that target to be reached and exceeded, which indeed it was. So far there's nothing wrong with this picture. The next interaction between price and the 80-day FLD is expected at the time that the first 80-day cycle trough forms in the market following the trough of 40-week magnitude in the middle of June. That time is upon us now, as I have already mentioned. Here is the nest of lows at the foot of the chart. And we would expect the 80-day cycle FLD to provide support at this time, at the time that the 80-day cycle trough is forming in the market. You might notice, and let me clear all of this, and let me actually unhighlight that FLD. There we go. There is a little bit of price action. Early today, I'm recording this video before the US markets open, and you can see there is the overnight price action from Sunday night and early Monday morning, and price has come right down to about the level of that 80-day FLD. Our expectation at this point is that the 80-day FLD should provide support. Price should now bounce out of the support area formed by the 80-day cycle FLD and out of the 80-day cycle trough. So according to this analysis, our expectation is, and let me just slide this chart over so that we can see a few more months here. There we go, and if I display the composite model line based only on the trough analysis, which is the analysis that we are considering at the moment, you can see that the composite model line, which takes all of the cycle information that results from the analysis on the chart, indicates that we are expecting price now to bounce out of the 80-day cycle trough. You must remember that when it comes to the composite model line, price levels are not the most important thing to consider. The most accurate element of the composite model line has to do with the structure of the price move. And so we are expecting a bounce out of the 80-day cycle trough to form now. Then, of course, price is going to come down into the 20-week cycle trough, which is expected towards the end of October, perhaps the middle of October, at about the earliest time that trough could form. And then price is going to bounce up again, form a second peak in the M shape of the current 40-week cycle. Then markets are going to turn down and move down into this 18-month cycle trough, which, as I've already mentioned, is expected early next year. So that is our expectation. We are going to be watching very carefully now to see whether the 80-day cycle FLD does provide support. If the 80-day cycle FLD does not provide support at this level, then it would indicate that the markets have turned more bearish than expected. And we might revisit the possibility that the 80-day cycle trough formed as a straddled trough a couple of weeks ago, and that price is now already moving down into the 20-week cycle trough. But there is no need for us to discuss that now, because we must watch to see what happens at the level of the 80-day cycle FLD before drawing any conclusions. This is the other analysis that I've mentioned in recent market update videos about the S&P 500. You can see that the data is actually the ES futures contract, but it is based upon the underlying S&P 500 index. And here we have a 54-month cycle trough in March of 2020, the pandemic trough. And you'll notice that there have been two 18-month cycles that have formed in the market since that time. The reason for that is because Sentient Trader is working with a slightly different nominal model. In other words, a different collection of cycles. That collection of cycles is determined by Sentient Trader as a result of the spectral analysis that it performs at the beginning of the analysis process. This is what we call an initial cyclic model, which is created as a result of the spectral analysis. And the analysis that Sentient Trader performs, the pattern recognition part of the analysis, which is the major part of the analysis that Sentient Trader performs, is based on a slightly different collection of cycles. In this case, as I've mentioned in previous videos in which I've discussed the ICM analysis, the cycles that it is working with are shorter than the nominal model that Hurst discovered 50 years ago, and the 18-month cycle is in fact only 15 months in length. And so according to this analysis, the trough that formed in the middle of June was not of 40-week magnitude, but 18-month magnitude. This is also not a particularly bullish analysis, because although it indicates the price is now bouncing out of an 18-month cycle trough, which is 1 degree stronger than the 40-week cycle trough we were looking at in the other analysis, we have this looming nest of lows for a trough of at least 54-month magnitude, possibly even 9-year magnitude, which is expected towards the middle of next year. So although it is a different analysis based on slightly different cycles, the implication is still fairly bearish, because we are expecting this to be the third 18-month cycle in the current 54-month cycle, bringing price down into a 54-month cycle trough in the middle of next year. Let's zoom in here and see what has been happening recently. There is the 80-day FLD for this analysis. Remember, the cycles are slightly different, and so the FLD is in a different position, because the FLD is simply median price displaced by the recent cycle wavelength, and so the FLD is in a slightly different position. You will also notice that I have influenced this analysis. Because of the shorter cycles that it is working with, the trough that formed in the middle of July makes sense to me as a 40-day cycle trough, and the 80-day cycle trough that I discussed recently as a potentially straddled trough I have actually positioned for Sentient Trader. I have pinned it, as you can see over here, at the beginning of August. The reason that I do this is because I like to keep an eye on both analysis possibilities. Although the implications of the two analysis possibilities are very similar, the big difference between the two analyses at the moment is that the trough that is forming in this analysis is of only 40-day magnitude, and so we are going to get a smaller bounce out of this trough. Not an 80-day cycle bounce, but only a 40-day cycle bounce. And the focus is very much on the fact that price is moving down into a 20-week cycle trough expected towards the end of September. You will remember that the other analysis expected the same magnitude cycle trough, a 20-week cycle trough, but it expected it a few weeks later. As price unfolds over the next few weeks, we will be able to distinguish with greater clarity which one of these analyses is the correct one. But if I display the composite model line for this analysis, you can see that our expectation in terms of the structure of the move is not, in fact, very different. We are expecting a bounce to occur now, in this case only a bounce out of a 40-day cycle trough, not an 80-day cycle trough. So it will be interesting to see what kind of a bounce we get. If we get a smaller, less significant bounce, then the odds are going to favor this analysis. Then price is going to turn down and move down into this 20-week cycle trough. I've already mentioned the difference in dates, either at the end of September or in the other analysis about the middle of October. It will be interesting to see where that 20-week cycle trough forms. If it forms earlier rather than later, then again we will favor this analysis. Then we are expecting price to bounce up into the second peak of the current 40-week cycle, exactly as we were expecting in the other analysis, and then price is going to move down into a trough early next year. This will only be a trough of 40-week magnitude, not the much larger magnitude trough that we are expecting in the other analysis. And so the structure of the move is going to be really important. Let's go back to the other analysis, the analysis that uses the default nominal model discovered by Hurst 50 years ago. The important conclusion that we can draw here is that we need to watch the way in which price interacts with this 80-day FLD. If price finds support at the level of this FLD and gives us a bit of a bounce out of this trough, then we will probably confirm this as a trough of the 80-day cycle. Then our expectation is as described by the composite model line, which is that price will bounce up, form another peak, and then move down into the 20-week cycle trough later in October. I do hope that you found this market update useful and interesting. If you have any questions, please visit our Hurst Cycles Discord server. There will be a link to that in the description below the video, or you can ask your questions in the comments below this video. I look forward to hearing from you.